there's a compelling macro theory gaining traction. We're witnessing a fundamental shift from a globalized, dollar-dominated world to one where power is distributed more evenly across nations. During this transition, the dollar's role is changing dramatically. If you've been wondering what's happening to the dollar lately, you might be watching the breakdown of our current monetary order in real time. Let me be clear about what I mean when I say the monetary order is breaking down. Take a look at this gold certificate from 1928. Back then, you could walk into a bank, present this certificate, and exchange it for actual physical gold. Or you could use a silver certificate, marked with this distinctive blue stamp, to get silver. The bank's original purpose was straightforward: protect real money. Notice something important? None of these certificates say Federal Reserve Note anywhere on them, unlike the money we use today. This was the era of hard money in American history. But in 1971, facing the threat of bankruptcy, the United States abandoned the gold standard entirely. The world entered a new monetary order where the dollar became the center of everything without being backed by anything tangible. Countries reached a new agreement. They would sell their goods and energy for dollars, then recycle those dollars back into U.S. assets like treasury bonds and stocks. This arrangement sent the stock market soaring indefinitely and allowed Americans to live beyond their means. It kept demand for the dollar high and enabled America to run persistent trade deficits. We could borrow cheap money, offshore jobs, and consume more than we produced. But here's the catch. For this system to function, the dollar had to remain strong. And it stayed strong, supported by the military-industrial complex. Now, all of that is changing. At the most recent World Economic Forum, we heard conversations about redistributing that power. The old rules-based order is fading. Leaders are saying they can build something bigger, better, stronger, and more just from the fracture we're experiencing. What we're seeing now are new trade agreements forming and countries diversifying their reserves. Instead of holding only dollars in the form of treasuries, they're seeking more forms of hard money. That's why assets like gold and silver are repricing right now. There's tremendous volatility because nobody knows exactly where this is headed. This is one of those hinge points in history that emerge every couple of generations. It doesn't make the path easy, and it doesn't mean every decision will be obvious. Countries aren't dumping the dollar overnight because that would hurt their own interests. But they are diversifying their reserves. Central banks are buying more gold instead of exclusively holding U.S. treasuries. China has already built a payment system that doesn't rely on U.S. banks. Meanwhile, the United States faces a massive debt problem and a shrinking industrial base. This means it can't sustain the old model forever. The model where we import everything, export paper money, and fund perpetual wars around the world. This transformation of the monetary order might explain why we're seeing gold and silver prices explode while the dollar weakens. In this video, I want to explain exactly what's happening with the dollar, why there might be a deliberate plan to weaken it, and where we might be headed from here. A portion of this video is sponsored by Webull, but I'll tell you more about them in a moment. With that said, let's dive in. Hi, thank you for joining Nuzik's Brief. I hope you're doing well. Stay with me as we explore this macro theory about transitioning from a globalized dollar-based system to a more regional, multi-power system where authority is shared among many countries. During this transition, the dollar's role is fundamentally changing, and to us, that change looks like currency weakness. This shows up everywhere we're looking right now. In the stock market, in commodities, in gold, silver, Bitcoin. Everything is experiencing enormous volatility because nobody knows where this is going. The obvious question is, isn't this bad for the US? This question was actually posed to Jerome Powell, the person in charge of the Federal Reserve, and he gave one of the strangest answers I've heard. When asked about the big movements in the dollar and the extent of recent volatility, Powell responded, "As you probably know, we don't comment on the dollar. The administration, especially the Treasury Department, has oversight over the currency, exchange rates, and all that. We don't comment on that. It's not our role. So I have nothing for you." What's fascinating about this answer is that every single dollar bill literally says Federal Reserve Note at the top. Everything the Fed does moves the dollar one way or another. The Fed's influence on the dollar is enormous. But the political consequences of admitting that wouldn't be favorable, which is why President Trump recently threatened Jerome Powell with criminal charges. The threat of criminal charges stems from the Federal Reserve setting interest rates based on their assessment of what serves the public, rather than following the president's preferences. The president wants lower interest rates, which Powell doesn't want to deliver. So Plan B appears to be potentially weakening the dollar. That's why, when Trump was asked about the weakening dollar in an interview, he said, "I think it's great. Look at the business we're doing. The dollar's doing great. Let me explain what a weaker dollar actually means. Whether it's good or bad depends on which version of America you're rooting for, because there are really two different U.S. economies. The first is the America we've lived in for the past 40 years. Let's call it financialized America. This version is built on a strong dollar, cheap imports, rising asset prices, and expanding debt. A strong dollar leads to cheap imports, which increases spending power, which enables more borrowing, which creates bigger and bigger financial markets. It's ultimately more debt. That's the world we're living in right now. In this system, America's main export, the thing it makes the most of, are dollars, treasury bonds, and financial assets. A strong dollar made America feel richer because everything overseas was cheaper for us to buy. This was by design. The system incentivized U.S. corporations to make input costs, especially labor, as cheap as possible. Through agreements like NAFTA, the North American Free Trade Agreement, it became easier to offshore jobs because American labor is expensive. Companies decided to avoid using American labor when possible, borrowing as much money as cheaply as they could, then using that money to inflate their stock values. This model worked incredibly well, but only as long as the rest of the world keeps buying U.S. debt forever in the form of treasuries. That's the America that benefits most from a stronger dollar. Then there's the other side, productive America. This is the version that actually builds things, produces energy, runs factories, and makes the stuff the world needs. But here's the trade-off. If the U.S. wants to return to that version of America and rebuild its industry, it doesn't benefit much from a stronger dollar. Why? A strong dollar makes your labor more expensive, which means less incentive for companies to build domestically. The same dollar strength that made consumers feel rich relative to the rest of the world is what hollowed out American industry. From this perspective, the U.S. might want a weaker dollar because it lowers the real burden of debt over time. It makes domestic manufacturing more competitive globally. It pushes capital toward real output and tangible assets instead of endless financial speculation, which primarily benefits industries like banking. Banks profit more from high interest rates, dollar dominance, and global lending. These two Americas are in conflict, quite literally. The president is even suing J.P. Morgan for debanking his family. But I won't speculate on that further. A weaker dollar is both good and bad. It's good if you want to win as a country long-term, because you build real things. That's what China did. But it's bad because the transition is painful and can last decades. Americans got used to the benefits of the old system, and fixing the economy takes a long time. There are countless unknowns, which ultimately leads to volatility across all markets. Before we continue, let me mention that markets are always trying to price in what happens in the future. Now, there are markets built specifically around that idea. I've been exploring Webull's prediction markets, where participants can take positions on outcomes like where the S&P 500 might be in the next hour, how crypto prices move, which sports team wins a game, or even upcoming Fed decisions. Instead of traditional trades, these are simple yes or no contracts tied to specific defined outcomes. For example, if something is trading at 25, the market is essentially implying a 25% probability of that outcome. As new information comes in, those probabilities update in real time. This is available through Webull's platform via a registered futures commission merchant, meaning the contracts are exchange-traded and regulated. Event contract trading is highly speculative and may not be suitable for all investors. Webull asks customers to carefully consider all risks associated with investing in event contracts, including the risks outlined in their event contract risk disclosure and other relevant disclosures at webull.com/policy, and to consult with financial professionals or advisors before investing. I'm compensated by Webull Financial LLC for this promotion, but check out the link in the description below. Now let's get back to it. Now that you hopefully understand why a weaker dollar could be beneficial or harmful, depending on your perspective, let me show you how this monetary order is breaking down in real life. I'm about to show you something that's going to blow your mind. We measure everything in dollars. But what happens when the thing losing value is the dollar itself? What happens to our time? This is where the monetary order starts to fracture. Let me show you what happens when we measure time in dollars. In the late 1960s, the federal minimum wage was $1.40 per hour. A 40-hour work week earned about $56. At the gold price of that time, around $35 per ounce, 1 week of work bought roughly 1.6 ounces of gold. Today, the federal minimum wage is obviously higher at $7.25 per hour. A full week of work earns about $290, significantly more than $56. But at today's gold price of, let's conservatively say $4,000 per ounce, you'd need to work 22 full-time weeks just to buy those same 1.6 ounces that took only 1 week back then. We're measuring the value of time in weaker and weaker dollars. That's what most people do, and that's why they can never get ahead. So the next question is, why was the ruler, the dollar, allowed to shrink in the first place? It seems unfair. It was allowed because this is the monetary experiment we're living through right now. This is Keynesian-style economics. This is how a debt-based monetary system built on credit works. Here's an easy way to understand it. If I lent you this $10 bill, let's say this $10 represents all the money in the world, but then I charged you a small 1% interest for borrowing it. Where would you get the money to pay me the interest? If this is all the money in existence, where does the interest come from? You couldn't pay me back. There's no more base money. So you have to expand it. You have to create more. That's an oversimplification. But the idea is that in a system built on credit, growth and expansion are necessary for stability. That's how, for decades, the US ran what was basically a consumer of last resort model. The world made stuff, sold it to America, earned dollars, and recycled those dollars back into US assets. This kept the dollar strong and interest rates low, propped up by countries like Japan acting as the interest-free lender. But that system depended on other countries wanting to hold unlimited dollar reserves. Today, this is changing. Countries and central banks are diversifying. We can see that gold has actually overtaken treasuries in central bank foreign exchange reserves. Think of foreign exchange reserves as a bank's piggy bank, a reserve wallet where it keeps various currencies. This is exactly what Ray Dalio describes in one of his latest interviews. We're going to have a supply-demand problem for debt while dealing with these other issues. A supply-demand problem for debt means we have much more supply of our debt than there is demand around the world to buy it. Instead, we're seeing central banks buying gold quite aggressively over the past few years. They're buying gold to protect themselves against whatever system replaces this monetary experiment we're running. More technically, something called Basel III changed how banks value gold on their balance sheets as of last year. Gold is now considered a higher quality reserve asset valued at market price instead of a discounted price. This doesn't mean gold replaces treasuries in the global financial plumbing system, but it does make gold much more attractive as a neutral reserve outside the dollar system. As a result of this debasement, to normal people like us, it looks like asset prices go up forever. You can see this in the MSCI index excluding the US and the same index including the US. It looks like the stock market rises everywhere. But if you measure both indexes in gold instead of dollars, you'll see that the market has actually lost value compared to gold since 2000. This is slightly cherry-picking data, but one could argue the last 20 years provide a good enough example. There's strong evidence that China and central banks buying massive amounts of gold has accelerated this trend, allowing them to build a parallel system to the dollar instead of relying solely on treasuries. What all this means is that structural demand for dollars might not grow the way it did before. That's exactly what we're seeing, demand for dollars gradually declining. That's what Ray Dalio is describing. Dollars are debt in the form of treasuries. If demand for them declines, we might see significantly more inflation in the future. Peter Schiff is someone who believes that's exactly what's going to happen. When told that people's incomes are solid and we're seeing real productivity gains, Schiff responded, "Unfortunately, the numbers aren't accurate. They're highly skewed and will be revised. Much of it is influenced by inflation. Inflation is going to be much more pernicious over the next few years than it was during the Biden presidency. That's what gold and silver are telling you. They're a warning. Now that we hopefully understand the dollar is weakening in relative terms and that this serves a structural economic purpose to make the US more competitive, but could also bring inflation, especially in asset prices. The next question is, who benefits most from this kind of transition? Let me explain this through the lens of my last video, using the 4 power players. Starting with the financial industrial complex, also known as transnational capital, money that transcends nations. This power comes from controlling the financial plumbing system: debt markets, stock markets, proxy votes. What they want is control over capital flow. They achieve this through the three asset managers we mentioned in the last video, who together manage more than $30 trillion. With that money, they use their clients' votes as proxies to influence company direction and leadership decisions. Then there are the banks, which want central bank digital currencies to stay relevant in this transition. But why would all these entities be fine with a weaker dollar? They'd be fine because they don't measure their wealth in dollars. They measure it in ownership of real assets, real money, things like stocks, real estate, infrastructure, energy, commodities. When a currency weakens, those kinds of assets tend to rise in nominal prices. It hurts people who rely on job income and benefits those with assets. The second player consists of the sovereigns, leaders of Tier 1 nations with access to nuclear weapons. What they want is more control over their supply chains, energy production, and populations. A slightly weaker currency helps rebalance trade in their favor because it makes domestic production cheaper and therefore more competitive overseas. While a strong dollar benefits consumers buying imports, a weaker currency benefits nations trying to rebuild their industries and reduces dependency on the old model of running deficits to fuel growth. A sovereign power like the United States could benefit from a weaker dollar. I know this sounds insanely complicated, but I hope it's making some sense. There's a slightly deeper layer to all this, and I hesitate to discuss it because it walks a fine line toward conspiracy. But it's the layer involving competition with China for maximum control, especially over society. That's the China model. This is where the third power player comes in, the tech-industrial complex. As the old monetary order becomes less dominant, whoever controls the new technological systems gains more influence and power. In my last video, someone asked a great question. How do mass deportations benefit the financial industrial complex? I'll be careful how I answer this, but I hope you can read between the lines. Throughout history, many economic transitional periods have coincided with new systems sold to us as protection. Digital identity tools, financial tracking systems, more centralized infrastructure. That's because uncertainty in markets and society increases demand for systems to control unrest. When things get chaotic around the world, technology is marketed as what will make us safer. Technology becomes the solution offered during times of instability. These technologies can change society's architecture for better or sometimes for worse. This is where digital IDs, social credit scores, kill switches, all that stuff come into play. The fourth player is the military-industrial complex, the layer that enforces these changes, often through instability, sometimes using religion as justification. When there's such a significant power shift, and we don't know the outcome, nations tend to invest more in their defense, energy sectors, and strategic leverage, consolidating regional proxies, engaging in land and resource grabs. Those are the four major power players and how they benefit. So what does all this mean for the average person? The honest answer is I don't know because I haven't lived 1,000 lifetimes. But the way I see it, there appears to be a fork in the road. One path is inflation, the other is deflation. On path 1, inflation could be triggered by perhaps the new Fed chair, Kevin Warsh, who's expected to lower rates. Though maybe he won't because he's been hawkish in the past. That means short-term volatility. If rates do decline and borrowing becomes easier, it becomes easier for the country to roll over the debt. If the world gradually wants fewer treasuries and more gold, as we're seeing, more dollars might stay within the country. That means deficits might grow and the currency might weaken further. In that world, asset prices can still soar. Stocks, real estate, commodities could go to the moon, partially because the measuring stick, the dollar, is shrinking due to inflation. Your portfolio goes up, but your purchasing power might not increase at the same rate. Life still gets more expensive for those without assets. The other path may be less optimistic. If investors worldwide look at the US and lose confidence, if capital leaves and interest rates rise to fight inflation, asset prices could fall. That's a much more painful outcome in the short term. I don't necessarily think it's the most likely outcome, but it remains a risk. Either way this plays out, whether through inflation, deflation, or some other scenario we're not considering, I think this transition still favors people who own assets more than people who rely on incomes. That's the K-shaped world we've been living in, and I think that divide will continue growing. Maybe technology and AI eventually create the world Elon Musk talks about, where robots do everything for us, and it's utopia. Maybe we get a productivity boom that offsets all of this. But even if we reach that point someday, the journey from now to that perfect future might be painful for people who aren't prepared for the time it takes to get there. I still believe in the theory that what we're seeing is largely political theater. The big decisions have already been pre-negotiated, and what we're watching is just the show. So enjoy the show, because some of it is genuinely funny if you're paying attention. Understanding these dynamics is crucial for navigating the uncertain times ahead. The monetary system that governed the world for the past 50 years is transforming before our eyes. Whether this leads to a more balanced global economy or triggers a period of instability depends on how leaders, institutions, and individuals respond to these changes. What's clear is that we're living through a historical inflection point, one that will shape economic reality for generations to come. The question isn't whether the change is happening. It's how we position ourselves to weather it and potentially thrive on the other side. I'd love to hear your thoughts on all of this. Smash the like button, subscribe if you haven't already, and I'd love to see you back here soon. Thanks for watching Nuzik's Brief. See you next time. Bye-bye.